Thank you. All right, moving on to the earnings momentum then, and Solex Energy is on our radar at the current moment. The stock is up almost 3.5% at this point, and it sees FY27 as a transition year, remember, with Q1 hit by seasonal weakness and expansion costs, but a strong order book. Now, the H2 execution pickup as well as maintained guidance keep the growth story intact. So, even though there has been a dip in the EBITDA margin for the company, the growth guidance for the second half of this particular year has really perked up that particular counter. Let's get chatting with the management on what's really creating this positivity around the plans as well as the guidance going forward. Dr. Chetan Shah, who's the chairman and managing director of Solex Energy, joins in now. Dr. Shah, always a pleasure to welcome you on NDTV Profit. First, I wanted to understand, you've given a good guidance. Of course, you are in an expansionary position, but the performance related margin, that is the profitability aspect that we really look at, and purely based on the performance parameters, there the EBITDA margin has taken a dip on a year-on-year basis. Of course, it's seasonally weak, but it's really comparing to the similar seasonally weak quarter in the last year. Can you help us understand that and also give us a guidance in terms of what is it that will change to really match with your overall guidance for the margin for the year?
Yeah, thank you. In fact, thank you for the question. It's a seasonal effect, definitely for sure. And then last quarter also we had the same impact. This year we have some additional impact, which is a ALCM. And ALCM created a lot of confusion in the market. And that's the reason there are deferment in deliveries and decision making. And that is the reason the Q1 numbers are impacted. Apart from that, we had expansion in last quarter of previous financial year. So we are loaded with a lot of depreciation and interest costs on our expanded capacity also. But nevertheless, it's H1, which is always lighter. We have seen for many decades that H1 is always lighter, and we are always heavy with H2. Considering our previous year performance, our this year also, as per our guidance, we will have a much better, superior H2, and we will cover up whatever that impact due to the ALCM we had in first quarter.
All right, so confident for the future, and of course you spoke about the various execution related pressure points on the balance sheet as well, especially with the finance charges and the interest cost. How are you positioned when it comes to Capex? Do you need more fundraise at this particular time? And with the finance charges, is that going to remain at these current levels? What is your prediction and projection for this financial year and the next?
Yeah, so for module business, we are not expanding at this stage. We announced our expansion, addition of our 2.5 module capacity by 2.5 gigawatt. But at this stage, considering the current market situation and the availability of the capacity in the market, we have decided not to go for the further expansion for module. So for module business, we will not have any additional capex and the cost of finance. But yes, as we mentioned about our expansion plan in cell manufacturing and BESS, we already signed MOU with the Government of Gujarat for 4,000 crore, where we are putting up a 5 gigawatt of cell, which is in two phase, 2.2 gigawatt and 3 gigawatt. And so 2.2 gigawatt will have capex of almost about 10150 crore, that is 1050 crore. And BESS, we are targeting 10 gigawatt of BESS, battery pack and container manufacturing. So this we will do in two phases of 5 plus 5. So this will also attract another capex of 250 crore around. So for this we have a subsidiaries, and then those capex will be done in those subsidiaries. And in LISCO directly we do not have any expansion plan for the module.
Right. So, Dr. Shah, you have charted out the expansion projects. Now, I want to understand in terms of your timelines and quarter to quarter performance uptick that you see either because of commissioning of some of the Capex and also the order book execution. Can you give us a sense of next 2 quarters visibility and beyond that, where the uptick in the performance will start to kick in?
Yeah. So basically, we do have a clear visibility for the H2, that is a quarter 3 and quarter 4. And this is a monsoon season, Q1 and Q2, and then affected by the hailstorm as well. But then, these are H2 is loaded, and we are already having order worth of 1,500 crore, which are the backed by the advances and PO from our customer, which are to be executed in H2. And then we have MSA already signed, and final round of documentation which is going on for the order worth of somewhere about 2,300 crore. So for the solar modules. So these are the orders that we need to execute in H2 and then the first part of the Q1 of the next financial year. So we have given we are in line with our guidance for the FY27, and we will be able to execute this.
Right. Also, Dr. Shah, what is the module realization trend that you are seeing in the present quarter versus the last quarter?
If you are mean by the utilization of our installed capacity, I would like to say that this year we are taking a very conservative numbers. We have a 4 gigawatt nameplate capacity with the availability of 3 gigawatt production. So last financial year, particularly in the last quarter of the financial year FY26, we reached up to 90% of our utilization. So this year we are going little conservative, and average utilization will be almost about 55% of our total nameplate capacity. This is what we are targeting.
Right. Cell manufacturing, Dr. Shah, is something very critical to the overall green energy thrust for the country. And that's where a lot of opportunity really lies. But as the technology really develops and it becomes more cheaper, it is much better. With your backward integration, and you already called that cell manufacturing is in the next earnings and at an inflection point, what is the margin improvement internally that you are going to see with the backward integration and the full chain and bouquet that you are creating in this particular space?
Yeah, so again, we are, giving some very conservative numbers as far as the margins are concerned, because our cell manufacturing will be become operational by December 2027, and by that time we see many other capacity also to come up, and then cost will be a little bit on a downside. But nevertheless, like we are considering EBITDA margin of somewhere about 20%, and with a PAT margin of around 10 to 12% after having our own cell manufacturing for our captive use.
Right. And finally, and very quickly, Dr. Shah, a little bit of more strategy on BESS opportunity for the company.
Yeah, so BESS is something which is the need of an hour for India. We do have a lot of challenges in terms of solar generation in daytime, and then evacuation not possible fully at daytime because of the limitation on uses. So BESS is something which is coming very fast. 100 gigawatts of orders are already awarded. Another 100 gigawatts are under preparation. So India will have a huge demand for the battery packs, the containerized solution for the storage, and the government is quite conscious about it. So the Solex has, is aligned with the demand. And we are planning to come up with the 5 gigawatt in first phase. We are coming up with the 5 gigawatt of BESS, battery pack and containerized solution. And this is what we are targeting in coming 12 to 14 months to become operational. Right. And for that, we are already tying up with the technology expert, international technology experts. Some of them are from the Europe as well. And yes, so this will actually bring us give us the advantage over the other company.
Right. Dr. Chetan Shah, it's always a pleasure to really take stock of all that expansion as well as the new projects that are really underway. All the best for this particular quarter, and the company is really in a formative stage in different areas of green energy, trying to capitalize on that particular potential. 2.5% up. Stock has taken a slight bit of dip with conservative outlook from the management.